The gold market, the gold futures market has not gotten control back of the gold price. Open interest remains extremely depressed, has not recovered despite the supposed ceasefire between Israel and the US and Iran. You see here that open interest maxed out at about 540,000 contracts over here just before gold topped at $5,600 an ounce. Liquidity in this market is going to be very, very scarce relatively for gold, which means the gold price will remain volatile. That includes silver because silver follows gold in volatility, normally speaking. Japan will release oil equivalent about 20 days of consumption from its strategic petroleum reserves. So when Japan goes kaput, the entire Western monetary system does as well, and we are almost there. India actually imports 55 to 65% of its oil through Hormuz. And the potential trouble spot for India if they lose their oil is also its currency, which we see is at all-time lows already at about 93 per dollar. Just ignore the news, ignore what people saying about the war, and just watch markets. What are the oil markets actually saying? They're saying that Hormuz is still closed. Let's go to the slides, and we will begin with open interest, and then we will talk about how much time remains before the oil market implodes or explodes, and which countries are going to be at ground zero, and how much time do each of them have before they run out of oil reserves and things get really bad. So let's check it out. First of all, we see here the interplay between open interest and the gold price. Talked about this last week, but there are some other interesting details here that I didn't point out before. The blue is the price, and the green bars are the open interest. You can see here we are below 360,000 contracts still. We went up slightly. It looked 2 days ago that we were up about 20,000, 375,000 contracts, but those turned out to be preliminary numbers by the COMEX or the CME or whoever runs that thing. And it turns out that preliminary numbers can be way off the actual numbers. Why? I don't know why. I don't know what the mechanics are here, but that's what it is. So we're still at very, very low open interest numbers that we haven't seen since 2012 or 2008. Actually, 2009. 2009. That's the one. Post-financial crisis. This is extremely low, which means that liquidity in the gold market is going to be very, very low, which is exactly what we are seeing. But I want to point out these candles over here.
The market looks calm, but the data underneath is quietly flashing a liquidity warning. As Rafi Farber points out here, open interest below 360,000 contracts hasn't been seen since the 2008 to 2009 crisis period, which signals a thin, fragile market structure. When liquidity dries up like this, even small capital flows can trigger outsized price swings, something most retail investors underestimate. The fact that preliminary data was wildly inaccurate also raises questions about transparency and reliability in core market metrics. This isn't stability, it's a setup for volatility spikes that can catch portfolios off guard. Next, Rafi Farber discusses what happens when this fragile structure starts breaking under pressure.
You see here that open interest maxed out at about 540,000 contracts over here just before gold topped at $5,600 an ounce. And in this candle where you see the top at $5,600, the open interest in gold had already started to fall drastically back down to, on that day, 460,000. So about 80,000 contracts were liquidated as gold was topping. And then one day later, gold crashed to, what is that, $4,700, and then back down to $4,400. So we went from about $5,500 to $4,400, an $1,100 move. What is that, about 20%? No, it's less. It's like 15%. It's still a lot for 2 days in the gold price. And open interest had already fallen by a lot by then, which means that whoever was doing that may have had a clue that gold was topping. And I'm not going to point to any conspiracies here. Some people who can track liquidity flows either by AI or algorithm or whatever, and they can see certain movements being made, which I don't have the ability to do because I don't have the data or the expertise to figure those things out. Some computer programs can figure it out, and some had, I guess, programmed that or figured out that gold was going to fall in those times because of those numbers. And some firms actually do this and they're wrong a lot, and some firms do it and sometimes they're right. It doesn't mean that they know anything insider or illegal or they're manipulating anything beyond what the system already manipulates. But this is what we are seeing here. We're seeing the open interest numbers fall right before gold topped. But now we see here that open interest is still below 360,000 contracts, even though the price has climbed from about $4,100 to now $4,800. So we moved about $700 with open interest falling even further. There are very, very few speculators in this market, and as the numbers continue to fall or as they stay around these levels, the liquidity in this market is going to be very, very scarce relatively for gold, which means the gold price will remain volatile. That includes silver because silver follows gold in volatility, normally speaking.
Price peaks don't start at the top. They start when participation quietly disappears. As Rafi Farber points out here, open interest collapsed by roughly 80,000 contracts before gold even peaked at $5,600, signaling that smart money was already exiting. That 15% drop in just 2 days wasn't random volatility. It was a liquidity vacuum forming in real time. When prices rise while participation falls, it often reflects weak conviction rather than strength, something rarely highlighted in bullish narratives. For investors, this means rallies built on thin participation can unwind fast and without warning. Next, Rafi Farber unravels how this same fragile dynamic connects to global oil risk.
But let's go to the situation in Hormuz. Apparently, there was a ceasefire between the US and Iran, and there was a deal to open Hormuz, which has not happened at all. This is the chart of what the strategic petroleum reserves are for the countries that are most reliant on the Straits of Hormuz. Does not include the United States. I don't know why the United States is here because they're not really reliant on the Straits of Hormuz. They only import about 5% of their oil from there. We do have China, Japan, and South Korea, and the EU. These are the sizes of their strategic petroleum reserves. And we see here that China has about 80 to 90 days estimated in reserve. Japan has about 175 days. That's combined government and private reserves. South Korea has about 90 days. And EU has about 9 days per member state. Who's going to run out first? Probably South Korea or China. Probably South Korea because they import most of their oil through Hormuz, whereas China only imports about half of it. Japan imports the most, but they have the biggest reserve. So we're going to go to the next slide here and we see Japan and the Strait of Hormuz. So Japan says here, this is from HormuzStraitMonitor.com. You can check it out yourself. They import about 80 to 90% of all their oil imports through Hormuz, and they have about 175 days of imports in reserve. So how long has the strait been closed? Since March 1st. It is now April 10th.
Energy security isn't equal, and the numbers here quietly expose who's most vulnerable. As Rafi Farber points out here, South Korea and China sit around 80 to 90 days of reserves, while the EU averages just 9 days per member state, an overlooked fragility in global supply chains. Japan looks safer at 175 days, but its dependence on Hormuz for up to 90% of imports creates a single-point failure risk. Markets often price oil broadly, but the real stress shows up unevenly across currencies, trade balances, and industrial output. For investors, this means regional shocks, not global ones, could drive the next volatility wave. Next, Rafi Farber shows how quickly those reserve timelines are already shrinking.
So that's about 41 days so far. Take that away from 175, and you have, what is it, 134 days? 130, yeah, 134. Am I doing the math right? Who cares? 134 days, let's say. So that's about 4 months. Is the Strait of Hormuz going to stay closed for that much longer? Maybe. I don't know. Why would Iran open it? I'm not sure. They pretty much lost everything by now, and maybe to save their power plants. But I don't think anyone's going to bomb their power plants. I think that was a bluff from the beginning. But anyway, you can see Japan is in serious straits here. Pun intended. Get it? Straits. Japan 10-year bond yield has now hit 2.442. This is a new high The high in 2026 was about 2.4 something right here. Now we're at 2.44. And as you know, my thesis is, if you've been watching these videos or following me on Substack, that the higher Japanese interest rates go, the weaker the yen gets, generally speaking, because the yen is the Japanese government bond market. They are the same thing. Now we see here a tweet from Javier Blas, who's the commodity guy at Bloomberg, and he says this is now confirmed.
A slow-moving supply crunch is now colliding with a fast-moving bond market signal. As Rafi Farber points out here, Japan has already burned through 41 days of reserves, leaving roughly 134 days while its 10-year yield hits a fresh high at 2.44%. Rising yields typically signal tightening financial conditions, but here they're paired with a weakening yen, exposing structural stress in Japan's debt-heavy system. This isn't just an oil issue, it's a currency and bond market feedback loop that could spill into global carry trades. Investors ignoring Japan's bond market are missing a key risk trigger. Next, Rafi Farber discusses how this pressure could escalate into a broader financial break.
Japan will release oil equivalent about 20 days of consumption from its strategic petroleum reserves in May, Prime Minister Sanae Takaichi said. So that's 20 days release, and they've already gone through about 41 days, so that's 61 days. So 175 minus 61 is 104. So we have about 3.5 months left of oil for Japan until they completely run out and the country stops. Isn't that exciting? So Japan here, this is the long-term chart of the 10-year bond yield. So you can see here 2.44 as we saw in the previous chart. This is going all the way back to the late 80s. And we see here that the high in the January 1999 was 2.695 over here. Trading Economics has a slightly different number. This is CNBC chart. I don't know which one is true and which one is lying. But whatever it is, we're around that high here. And after that, we have basically outer space over here, which is not good if you're a Japan guy or anyone who depends on Japan, like everybody, because they have a huge carry trade, which keeps the fiat system alive.
A shrinking oil buffer is now colliding with a breaking bond market, and that combination rarely ends quietly. As Rafi Farber points out here, Japan effectively has around 104 days of oil left after accounting for usage and planned releases, while its 10-year yield pushes toward historical highs near 2.7%. That's not just a supply issue, it's a liquidity and leverage problem tied to global carry trades built on cheap yen. If yields continue rising into mid-2026, funding costs spike across markets, hitting equities and risk assets globally. This is where macro stress leaks into portfolios. Next, Rafi Farber discusses how this pressure spreads beyond Japan.
So when Japan goes kaput, the entire Western monetary system does as well, and we are almost there. South Korea and the Strait of Hormuz. What about South Korea? It imports 70 to 80% of its oil through Hormuz. And we see here, where is the potential for a crisis in Korea? It's not quite in the 10-year yield, though it could be, though history says that the South Korean won is more of a troublemaker than the 10-year Korean bond, whatever they call their bonds. So we see here that the Asian financial crisis in 1998 saw the Korean won crash from about 800 to about 2,000 per dollar. And we had another crash in 2008, and it looks like we are at 2008 crash levels over here of about 1,500. And so this could erupt at any time, and South Korea could lose its currency. If it loses its oil reserves, they have about 90 days, and we've done about 41. So maybe about 50 days left here for South Korea to run out of oil.
Currency crises don't begin with headlines. They begin with resource constraints markets quietly price in early. As Rafi Farber points out here, South Korea is down to roughly 50 days of oil runway, while its currency sits near stress levels last seen during the 2008 financial crisis. That combination, energy dependency and a weakening currency, creates a feedback loop where imports get more expensive just as supply tightens. Investors often focus on interest rates, but here the real risk sits in FX volatility spilling into equities and trade-sensitive sectors. This isn't isolated, it's systemic fragility building. Next, Rafi Farber shows how this pressure extends into other major economies.
Who knows what happens then? Do they start importing from a different country? I don't know, but it's not good for them. India and the Strait of Hormuz. So India actually imports 55 to 65% of its oil through Hormuz. And the potential trouble spot for India if they lose their oil is also its currency, which we see is at all-time lows already at about 93 per dollar. And the currency has been weakening since the late 1970s, and this could crash at any time, especially if they don't have any oil to run their economy. If you can't run your economy, your currency dies with it. But which country involved in this war currency is at an all-time high? That's actually Israel. The US dollar to Israeli new shekel ratio is now down to about 3. We're at 3.0367. If we look at an all-time chart here, squeeze this out, or not squeeze, it's the opposite squeeze, broaden this out to 1985 with the founding of the Israeli new shekel.
A weakening currency paired with energy dependence is one of the most underappreciated risks in emerging markets. As Rafi Farber points out here, India relies on Hormuz for up to 65% of its oil, while its currency hovers near record lows around 93 per dollar. That's not just a forex issue. It directly impacts inflation, corporate margins, and consumer demand across sectors. Meanwhile, Israel's currency strength highlights how capital flows don't always follow geopolitical narratives, creating confusing signals for investors. This divergence matters for global portfolio allocation. Next, Rafi Farber discusses why currency strength doesn't always reflect economic reality.
And we're pretty much at a major high, not all time, because we were back here in 1995 before the currency actually stabilized in 2000. We're at 3.03. Why is the shekel strengthening? We are at about 30-year high here of 3.03, and what was the low today? It was like, oh wow, 2.92. We went below 3 shekels to a dollar. Wow. So the shekel has, since October 7th, since the big attack and this whole war broke out, the shekel has gone from 4 shekels per dollar to below 3. That's a 25% increase in the shekel to the dollar. And yes, this is irrelevant in terms of the end game because the shekel basically is the dollar because the Bank of Israel owns only dollars. But well, whatever. I mean, investors seem to want the shekel for some reason.
You guys take shekels? Just got back from a trip to Israel. All I got is a fistful of shekels.
I know that a lot of people think that Tel Aviv was destroyed and that the country is in ruins or whatever.
A rising currency during geopolitical stress should raise more questions than confidence. As Rafi Farber points out here, the shekel has strengthened roughly 25% since October 7th, moving from 4 to below 3 per dollar despite ongoing conflict. That kind of move suggests capital positioning or central bank dynamics rather than pure economic strength. When currencies detach from on-the-ground realities, it often reflects deeper liquidity flows or policy interventions that markets don't fully explain. For investors, this creates false signals that can distort risk assessment. Next, Rafi Farber unravels what market prices are really telling us beneath the headlines.
But if that were true, the shekel wouldn't be so strong versus the dollar. Basically, what we all have to do now is ignore the news, ignore what people are saying about the war, and just watch markets. What are the markets actually saying? What are the oil markets actually saying? They're saying that Hormuz is still closed. Ships are not passing by. It's about a 90% blockage still. Hasn't changed much since the war started. And yes, in these times when it is impossible to know what the truth is, I do believe you can still follow market prices. Those are actual information about the situation in the economy. As Hayek said, the Austrian economist, prices are signals and they organize the division of labor. Without prices, we would not know what to do when we woke up in the morning, and it would be a zombie apocalypse. So in these times, I would say ignore the news and keep your eyes on the actual prices of goods and services in the global economy. They are what people are buying and selling for, and they tell the truest information. And from what we can tell, Gold and silver are rising, which means the dollar is dying because everything really is priced in gold. Nothing really is priced in the dollar since the dollar is a gold derivative. And the rest of it, beyond that, is all debt that's going to collapse in an endgame.
When narratives break down, markets often reveal truths that headlines can't. As Rafi Farber points out here, a 90% blockage in Hormuz alongside rising gold and silver prices signals real supply stress and shifting confidence in fiat systems. But the leap from rising metals to a dying dollar oversimplifies a more complex global liquidity picture. Prices do reflect reality, but they also reflect positioning, policy, and speculation layered together. For investors, blindly following price signals without context can be just as risky as ignoring them entirely.